Chapter 1, Financial Systems 1. Define the financial system. A financial system refers to a structured network of financial institutions, markets, instruments, and mechanisms that facilitate the movement of funds within an economy. Its main function is to transfer money from those who have excess funds, savers, to those who need funds, borrowers. Savers include individuals or households who save money, while borrowers include businesses, governments, and individuals who require funds for investment, consumption, or development purposes. This flow of funds is important because savers may not always have profitable opportunities to invest their money, whereas borrowers often have productive ideas or projects but lack sufficient capital. Therefore, the financial system helps allocate resources efficiently and supports economic growth. It also allows individuals and firms to manage their spending, savings, and investment decisions over time. There are two main methods through which funds are transferred in a financial system. The first is direct finance, where borrowers raise funds directly from lenders in financial markets by issuing financial instruments such as shares or bonds. The second is indirect finance, where financial intermediaries such as banks and financial institutions act as a bridge between savers and borrowers. These intermediaries collect deposits from savers and lend them to borrowers, a process known as financial intermediation. This is the most common method used in modern economies. Overall, the financial system plays a crucial role in ensuring efficient allocation of funds, promoting investment, and maintaining economic stability. 2. The structure of the financial system. The structure of a financial system can be understood by examining the key entities, such as financial markets, securities, and financial intermediaries. These components work together to facilitate the flow of funds within the economy. 1. Financial markets. Financial markets are platforms where funds are transferred from individuals or institutions with surplus funds to those with a shortage of funds. They play an important role in improving resource allocation, supporting investment, and enhancing economic efficiency. Financial markets, such as bond and stock markets, also influence personal wealth and business decisions. Example: a company raises funds by issuing shares in the stock market, where investors purchase them. 2. Securities, financial instruments. Securities are financial claims on the future income or assets of the issuer. They represent liabilities for the issuer and assets for the investor. The two main types are bonds and stocks. Bonds provide fixed periodic payments over a specified period, while stocks represent ownership in a company. Governments and corporations use these instruments to raise capital. Example: an investor buys government bonds to earn interest or purchases company shares to gain ownership and dividends. 3. Financial intermediaries. Financial intermediaries are institutions that act as a bridge between savers and borrowers by buying and selling financial contracts and securities. They collect funds from savers and lend them to borrowers, facilitating indirect finance. Banks are the most common intermediaries, accepting deposits and providing loans. Other intermediaries include insurance companies, mutual funds, and pension funds. Example: a bank accepts deposits from customers and provides loans to businesses for expansion. In conclusion, these three components form the core structure of the financial system, ensuring efficient flow of funds and supporting economic development. 3. Explain the functions of a financial system. The financial system plays a vital role in the economy by helping individuals, businesses, and governments manage money efficiently. It ensures that funds are available where they are needed and supports overall economic growth and stability. The main functions of a financial system are as follows. 1. Providing funds for businesses and individuals. The financial system helps funds to transfer from individuals or institutions with surplus funds to those with a shortage of funds. This allows businesses to invest, expand, and create job opportunities. Example: a bank collects deposits from customers and provides loans to a company to open a new branch. 2. Making payments convenient. It provides safe and efficient payment methods that reduce the need for cash and make transactions faster. This is important for both daily use and business operations. Example: customers can pay for products using online banking, debit cards, or e-wallets instead of cash. 3. Encouraging saving and investment. The financial system offers stocks or bonds for people to save money and earn returns. This helps individuals grow their wealth and supports investment in the economy. Example: people deposit money in banks or invest in shares and bonds to earn interest or dividends. 4. Managing financial risk. The financial system reduces risk by offering products like insurance, which protect individuals and businesses from financial losses. This increases confidence in economic activities. Example: individuals buy insurance to protect themselves from unexpected losses, such as accidents or damage. 5. Supporting economic growth. The financial system supports the development of businesses and industries by ensuring the smooth flow of funds. This leads to increased production, employment, and income levels. Example: a startup receives funding from banks and grows into a successful company. In conclusion, the financial system is essential for managing money, supporting business activities, and promoting economic development in a country. 4. List and explain 5 types of financial markets. Financial markets are platforms where funds are transferred from individuals or institutions with surplus funds to those with a shortage of funds. They play an important role in improving resource allocation, supporting investment, and enhancing economic efficiency. There are different types of financial markets, each serving specific purposes. 1. Money market. The money market deals with short-term financial instruments, less than 1 year, and helps financial institutions manage liquidity and cash flow. The money market is considered low risk and highly liquid. Example: Treasury bills and Bank Negara bills are used by governments and banks to manage short-term funds. 2. Capital market. The capital market deals with long-term financial instruments such as stocks and bonds, allowing companies and governments to raise funds for expansion and development. Investors can earn returns through dividends or interest. Example: a company issues shares to the public through the stock market to raise funds for business growth. 3. Foreign exchange market, Forex. This market involves the buying and selling of different currencies. It is essential for international trade and investment, as businesses need to convert currencies when dealing across countries. Example: a Malaysian company exchanges ringgit for US dollars to import goods from the United States. 4. Derivatives market. The derivatives market trades financial contracts whose value is derived from underlying assets such as stocks, commodities, or currencies. It is mainly used for risk management and speculation to protect against financial uncertainty. Example: a company uses futures contracts to lock in the price of oil to avoid price fluctuations. 5. Commodity market. The commodity market deals with the trading of physical goods such as gold, oil, and agricultural products. It ensures stable pricing and efficient distribution of essential resources. Example: investors trade gold as a safe investment during economic uncertainty. In conclusion, financial markets are essential for economic growth as they provide platforms for investment, liquidity management, and risk control across different sectors. Chapter 2. Financial Intermediaries 1. Types of financial intermediaries. Financial intermediaries are institutions that act as a bridge between savers and borrowers by buying and selling financial contracts and securities. They collect funds from savers and lend them to borrowers, facilitating indirect finance. They provide benefits such as security, liquidity, and better management of financial resources. 1. Commercial banks. Commercial banks are financial institutions that accept deposits from the public and provide loans to individuals and businesses. They support daily financial activities and economic growth by offering services such as savings accounts, current accounts, and payment systems. Example: a bank collects customer deposits and provides a business loan to open a new branch. 2. Investment banks. Investment banks help companies and governments raise capital by issuing shares and bonds. They also provide financial advice for mergers, acquisitions, and large investments. They do not take deposits like commercial banks. Example: a company uses an investment bank to issue shares in the stock market to raise funds. 3. Insurance companies. Insurance companies provide financial protection against risks such as accidents, illness, or property loss. They reduce uncertainty by offering compensation when unexpected events occur. For example, a person buys health insurance to cover hospital expenses, so they do not have to pay the full cost during medical emergencies. 4. Pension funds. Pension funds collect contributions from employees and employers and invest them to provide income after retirement. They help individuals ensure long-term financial stability. Example: an employee contributes monthly to a pension fund and receives income after retirement. 5. Mutual funds. Mutual funds pool money from many investors and invest in assets such as stocks and bonds. They are managed by investment banks and help reduce investment risk. Example: an investor invests in a mutual fund to earn returns without directly managing stocks. 6. Credit unions. Credit unions are member-owned financial institutions that provide savings accounts and loans at lower interest rates. They focus on helping members rather than making profits. Example: a student joins a credit union to get a low-interest education loan. In conclusion, financial intermediaries play an important role in ensuring smooth fund flow, reducing risk, and supporting economic growth. 2. What is the role of financial intermediaries? Financial intermediaries act as a bridge between savers, who have surplus funds, and borrowers, who need funds. They perform several key functions in the economy. 1. Mobilizing savings, financial intermediaries encourage individuals and businesses to deposit money, which is then made available for lending. For example, commercial banks accept deposits from households and use these funds to provide loans to businesses. 2. Providing credit and financing, intermediaries supply funds to borrowers for investment, trade, or consumption, which supports economic growth. For instance, finance companies provide loans to small businesses for expansion or equipment purchase. 3. Risk management and liquidity. Financial intermediaries collect money from many savers and spread it across different investments to reduce risk. They also provide liquidity, allowing savers to access funds on demand. For example, pension funds invest in long-term projects but allow contributors to receive regular payouts. In conclusion, financial intermediaries are essential for allocating resources efficiently, supporting investments, managing risk, and maintaining liquidity, all of which contribute to a stable and growing economy. 3. Reasons for the existence of financial intermediaries. Financial intermediaries exist to connect savers with surplus funds to borrowers who need funds, while reducing problems in financial markets such as high transaction costs, lack of information, and liquidity risks. They play an important role in improving efficiency, reducing risks, and supporting economic growth. 1. Asset transformation. Financial intermediaries transform financial assets by converting short-term deposits into long-term loans. Example: banks use customer savings to provide long-term business loans for expansion projects. 2. Reducing transaction costs. They reduce the cost and effort of borrowing and lending by acting as middlemen. Example: Maybank evaluates borrowers' creditworthiness and manages loan repayments, saving time and cost for customers. 3. Liquidity insurance. Financial intermediaries provide liquidity by allowing depositors to withdraw money when needed. This gives customers flexibility and financial safety. Example: CIMB Bank allows customers to withdraw savings anytime while using the funds for long-term lending. 4. Information management. They solve information problems such as asymmetric information, where borrowers know more than lenders. Intermediaries assess borrower risk and monitor loan usage to reduce default risk. Example: banks evaluate credit history before giving loans and monitor repayment behavior. In conclusion, financial intermediaries exist to improve efficiency in financial markets by reducing costs, managing risks, providing liquidity, and solving information problems. This supports business financing and promotes overall economic stability and growth. 4. Advantages and disadvantages of financial intermediaries. Financial intermediaries play an important role in the financial system by connecting savers and borrowers and ensuring smooth flow of funds in the economy. They provide many benefits, but also have some limitations. Advantages: 1. Efficient financial system. Financial intermediaries make financial transactions easier by providing a structured system for saving, borrowing, and investing. This reduces the need for individuals to directly search for lenders or borrowers. Example: A bank allows customers to deposit money and apply for loans through one institution. 2. Risk diversification. They reduce financial risk by spreading funds across many borrowers and investments. This helps protect customers from losing all their money if one investment fails. Example: a bank lends money to many businesses instead of only one company. 3. Professional financial services. Intermediaries offer expert advice and financial planning services, helping customers make informed decisions about saving and investment. Example: a bank officer advises customers on fixed deposits or investment plans based on their goals. Disadvantages. 4. Conflict of interest. Some intermediaries may promote financial products that give them higher commissions instead of the best option for the customer. This can affect trust and decision-making. Example: a financial advisor recommends a product mainly because it offers higher commission. 5. Additional costs. Financial intermediaries charge fees for their services such as loan processing, account maintenance, or investment management, which increases overall costs for customers. Example: banks charge service fees for managing accounts and processing loans. Conclusion. In conclusion, financial intermediaries improve efficiency, reduce risk, and provide professional support, but they may also increase costs and sometimes create conflicts of interest. Chapter 3. Financial Institutions 1. 5 types of financial institutions. The financial system plays a vital role in the economy by helping individuals, businesses, and governments manage money efficiently. It ensures that funds are available where they are needed and supports overall economic growth and stability. 1. Commercial banks. Commercial banks are financial institutions that accept deposits from the public and provide loans to individuals and businesses. They support daily financial activities and economic growth by offering services such as savings accounts, current accounts, and payment systems. Example: a bank collects customer deposits and provides a business loan to open a new branch. 2. Investment banks. Investment banks help companies and governments raise capital by issuing shares and bonds. They also provide financial advice for mergers, acquisitions, and large investments. They do not take deposits like commercial banks. Example: a company uses an investment bank to issue shares in the stock market to raise funds. 3. Insurance companies. Insurance companies provide financial protection against risks such as accidents, illness, or property loss. They reduce uncertainty by offering compensation when unexpected events occur. For example, a person buys health insurance to cover hospital expenses, so they do not have to pay the full cost during medical emergencies. 4. Central banks. Central banks are responsible for managing a country's monetary policy and ensuring financial stability. They regulate other banks, control inflation, and adjust interest rates to maintain economic balance. Example: Bank Negara Malaysia increases interest rates to control inflation and stabilize the economy. 5. Non-banking financial companies, NBFCs. NBFCs provide financial services such as loans and credit facilities without operating as full banks, helping individuals and small businesses access finance when they cannot get bank loans. Example: a financing company provides quick personal loans to customers with simple requirements and fast approval. In conclusion, financial institutions play an important role in the economy by connecting savers and borrowers, providing financial services, and supporting economic growth. They help ensure funds are used efficiently, reduce financial risks, and improve overall financial stability in the system. Chapter 9. Investment. 1. Investment bank versus commercial bank. Investment banks help companies and governments raise capital by issuing shares and bonds. They also provide financial advice for mergers, acquisitions, and large investments. They do not take deposits like commercial banks. An investment bank is not the same as a commercial bank, although both are important types of financial institutions. They differ mainly in their functions, services, and level of risk. 1. Nature of services. Commercial banks focus on basic banking services such as accepting deposits and providing loans to individuals and businesses. In contrast, investment banks help companies to raise capital and provide advisory services. Example: Maybank offers savings accounts and loans, while CIMB Investment Bank helps companies issue shares and bonds. 2. Source of funds. Commercial banks obtain funds mainly from customer deposits, where investment banks raise funds through capital markets and investors. Example: a commercial bank uses customer savings to provide housing loans, while an investment bank raises funds by selling securities to investors. 3. Risk level. Commercial banks have lower risk because they deal with secured loans and regulated deposits, while investment banks have higher risk due to uncertain profits from trading securities. Example: a commercial bank earns steady interest income, while an investment bank may gain or lose depending on market performance. 4. Client focus. Commercial banks serve the general public, including individuals and small businesses, while investment banks mainly serve large corporations, governments, and institutional investors. Example: individuals open accounts in commercial banks, while large companies approach investment banks for raising capital. 5. Role in economy. Commercial banks support daily financial needs and liquidity in the economy, while investment banks support business expansion and economic growth through large-scale financing and restructuring. Example: commercial banks help individuals save and borrow, while investment banks help companies expand globally. In conclusion, investment banks and commercial banks are not the same. Commercial banks focus on deposit taking and lending with lower risk, while investment banks focus on capital markets and advisory services with higher risk and return. Both play complementary roles in supporting economic development. 2. Key characteristics of investment banking. Investment banking plays an important role in helping companies raise capital and manage large financial transactions. However, it involves higher risk compared to traditional banking, but also offers the potential for higher returns. 1. Higher risk and reward. Investment banking activities, especially issuing securities, involve significant risk because banks commit large amounts of money. However, if successful, they can earn high profits. Example: Goldman Sachs may earn substantial fees when a company's shares perform well after being issued. 2. Estimation. Investment banks must estimate the value of new securities before selling them to investors. This process is complex and uncertain because it depends on future performance and investor demand. Example: an investment bank estimates the share price of a new company before launching it in the stock market. 3. Market dependence. The success of investment banking depends heavily on market conditions. If market prices rise after securities are issued, profits increase. If prices fall, losses may occur. Example: a company's shares may perform well in a strong market but decline during an economic slowdown. 4. External factors. Unexpected events such as economic crises, political instability, war, or regulatory changes can affect investment outcomes. These factors are beyond the control of investment banks but can significantly impact profits. Example: a sudden change in government policy may reduce investor confidence and affect stock prices. 5. Profit or loss outcome. Investment banks may face either profit or loss depending on how the securities perform in the market. A price increase leads to higher returns, while a decrease forces the bank to absorb losses. Example: if the share price drops after issuance, the investment bank may have to sell at a lower price and incur losses. In conclusion, investment banking services offer high potential returns but come with significant risks and uncertainties. Their success depends on accurate estimation, favorable market conditions, and external economic factors. 3. Discuss 4 major investment products offered by investment banks. Investment banks offer a variety of investment products that help investors and companies manage capital, raise funds, and grow wealth. These products also provide opportunities for profit, but they carry different levels of risk. 1. Stocks, equities. Stocks are a type of financial security that represent ownership in a company. They are traded in the stock market and are an important source of financing for companies while also providing investment opportunities for individuals. Example: a company sells shares to the public through an investment bank to raise capital for expansion. 2. Bonds. Bonds are debt instruments where investors lend money to a company or government in return for fixed interest payments. Investment banks help issue and sell bonds in the market. Example: A government issues bonds to finance infrastructure projects like highways. 3. Mutual funds. Mutual funds pool money from many investors and invest in assets such as stocks and bonds. They are managed by investment banks and help reduce investment risk. Example, an investor invests in a mutual fund to earn returns without directly managing stocks. 4. Derivatives. Derivatives are financial contracts whose value comes from underlying assets such as stocks, commodities, or currencies. They are used for risk management and speculation. Example, a company uses a futures contract to lock in the price of oil to avoid future price increases. In conclusion, investment banks offer a wide range of investment products such as stocks, bonds, mutual funds, and derivatives that help investors and companies achieve different financial goals. Chapter 10. Investment Function. 1. Popular money market investment instruments. The money market consists of short-term financial instruments that are highly liquid and low risk. These instruments are used by governments, banks, and corporations to manage short-term funding needs and maintain liquidity in the financial system. 1. Treasury bills, T-bills. Treasury bills are short-term government securities issued at a discount and redeemed at face value. They are low risk because they are backed by the government, and investors earn profit from the difference between the purchase price and the maturity value. Example, a government issues a T-bill to raise short-term funds for public spending. 2. Negotiable certificates of deposit, NCDs. NCDs are fixed-term deposits issued by banks that can be traded before maturity. They offer higher returns than normal deposits and provide both income and liquidity to investors. Example, a bank issues an NCD to attract investors who want short-term investment with better returns. 3. Commercial papers, CPs. Commercial papers are short-term unsecured debt instruments issued by large companies to raise working capital. They have a maturity of up to 270 days and are issued by firms with strong credit ratings. Example, a company issues commercial paper to pay suppliers before receiving payments from customers. 4. Repurchase agreements, repos. Repos are short-term borrowing agreements where securities are sold and later repurchased at a higher price. They are used by banks to manage liquidity and by central banks to control money supply and interest rates. Example, a bank sells government securities and agrees to buy them back the next day. 5. Bankers' acceptances, BAs. Bankers' acceptances are short-term financial instruments used in international trade. They are bank-guaranteed time drafts that ensure payment to exporters and can be traded before maturity. Example, a bank guarantees payment for imported goods, making trade safer for both buyer and seller. In conclusion, money market instruments such as T-bills, NCDs, commercial papers, repos, and bankers' acceptances are important for short-term financing, liquidity management, and maintaining stability in the financial system. 2. Stocks as financial securities. Stocks are a type of financial security that represent ownership in a company. They are traded in the stock market and are an important source of financing for companies while also providing investment opportunities for individuals. Stocks help connect investors with businesses that need capital for growth and expansion. 1. Capital formation. Stocks are equity securities that allow companies to raise long-term funds by selling ownership shares to investors instead of borrowing money. Example, company issues shares to the public through the stock market to raise money for building a new factory. 2. Marketability feature. Stocks are actively traded in the capital market, and their prices change based on supply and demand, company performance, and economic conditions. Example, investors buy and sell company shares daily on the stock exchange based on market trends. 3. Corporate financing. Stocks provide permanent capital, allowing businesses to expand without financial pressure from debt repayment. Example, a company issues shares to finance research and development of new products. 4. Investor benefits. Stocks give investors ownership rights in a company, encouraging individuals to participate in financial securities and build wealth. Example, an investor earns profit when the company pays dividends or when share prices increase. 5. Risk and return. Stocks are high-risk securities because their prices change with market and economic conditions, but they also offer higher return potential compared to other investments. Example: a company's share price may increase during strong economic growth but fall during a recession. In conclusion, stocks are essential financial securities that support capital formation, business expansion, and investment opportunities. Although they carry higher risk, they provide strong return potential and play a key role in the financial system. 3. Factors affecting choice of investment securities. The choice of investment securities depends on several important factors that influence an investor's decision-making process. These factors help investors select suitable investments based on their risk tolerance, return expectations, and financial goals. 1. Expected rate of return. This refers to the profit an investor expects to earn from an investment, including interest, dividends, or capital gains. Investors often compare returns using measures such as yield to maturity, YTM, or holding period yield, HPY. Before making decisions. Example: an investor chooses a bond that provides higher annual returns compared to others in the market. 2. Risk, credit default risk. This is the risk that the issuer may fail to pay interest or repay the principal amount. Generally, higher risk investments offer higher returns, while lower risk investments provide safer but lower returns. Example: government bonds are safer than corporate bonds because they have lower default risk. 3. Liquidity. Liquidity refers to how easily an investment can be converted into cash without losing significant value. Highly liquid securities are preferred because they can be sold quickly when needed. Example: shares listed on a stock exchange are more liquid than fixed deposits. 4. Taxation. Tax policies affect the actual return earned by investors. Some investments are taxed on interest or capital gains, which reduces net profit. Example: an investor may prefer tax-free government bonds over taxable securities. 5. Inflation risk. Inflation reduces the purchasing power of money over time. If inflation increases, the real value of investment returns decreases, affecting long-term investment decisions. Example: fixed-income investments may lose value when inflation is high. In conclusion, investors consider expected return, risk, liquidity, taxation, and inflation when choosing securities. These factors help them make balanced decisions between safety and profitability. 3. Stock versus bonds. Stocks and bonds are two fundamental financial securities used by corporations and governments to raise capital, but they differ significantly in structure, risk, and return characteristics. Bonds are long-term debt instruments issued by governments or corporations to borrow funds from investors. When an investor purchases a bond, they are essentially lending money to the issuer in exchange for periodic interest payments, coupon payments, and the repayment of the principal amount at maturity. Bonds are generally considered lower-risk investments because they provide fixed and predictable income, and in many cases, such as government bonds, they are backed by sovereign guarantees. However, they typically offer lower returns compared to equities, and investors may face risks such as default risk, interest rate risk, and inflation risk, which can affect the real value of returns. Stocks, also known as equities, represent ownership in a company. When investors buy shares, they become partial owners and are entitled to a portion of the company's profits, usually in the form of dividends, as well as capital gains if the share price increases. Stocks are typically issued by companies to raise permanent capital without any obligation of repayment. Compared to bonds, stocks offer higher return potential, but also carry greater risk due to market volatility, uncertain dividend payments, and fluctuations in company performance. The value of stocks is influenced by economic conditions, investor sentiment, and corporate performance, making them more suitable for investors with higher risk tolerance and long-term growth objectives. In conclusion, bonds provide stability and predictable income, making them suitable for conservative investors, while stocks offer higher growth potential but with increased risk. A well-balanced investment portfolio often includes both instruments to achieve diversification and manage risk effectively.